Aman, good morning. Thank you for joining us. Uh, I can see a lot of trophies, a lot of squirrels. Where is Lakshmi ji behind you? I cannot see that.
I need to, yeah, you can, on my left.
Oh, importance of Lakshmi. Okay, it's been a good market. What to your mind is really fueling this price action? Is it turn in macros or turn in liquidity?
It's been not just good, it's been a fantastic market last 2 months, especially for the mid and small caps. And it's been a great move. Most of the stocks from the 31st March lows would be up anywhere between 20 to 30, 35%. So it's been a great run. I think it's a combination of liquidity. Macros is always good. Nothing has changed as far as the macro is concerned in the last 2 months. What has definitely helped is the way US markets have recovered. Nasdaq specifically has recovered. Stocks there, the FANG stocks also have almost doubled, or some of them have even more than doubled from the lows. So that has been the sentiment changer for India, along with liquidity. And we all know when the retail participant comes in, it comes predominantly in the mid and small cap. But that is what we have seen in the last 2 months, and it's been an amazing run.
How would you stack up the risk reward ratio after the recent run? Do you think this market still has a long way to go before it tops out?
It has to be always stock specific. The market has a long way to go up. It's all about what time frame you look at. From here on also, macros are looking good. Interest rates have peaked out. They are soon going to start coming off, which we all know. Inflation has also started to come off. Demand as such is also got impacted, but investors are choosing to look at the bigger macro. They're fine. Demand will come back once interest starts to come off, and that's what is fueling the interest in equity markets. So market still has a long way to go. We will be soon heading ahead of the central election, so there's going to be massive ordering, there's going to be positive vibes, there's going to be positive order books, and that is all what Indian equity investors are looking forward to. So I think it's still a long way for markets to go, and if India continues to do the way it is, that being the fastest growing economy, FIs flows also have to start coming back. We have already seen it coming back, and this should sustain. So if that happens, then it's a decent rally ahead of us, is what I would feel.
Aman, are you recommending buying into markets even at these levels? And if so, where is your bullish tilt towards? Any stocks or sectors?
Yeah, there is always something which is looking good. There is always something which is looking expensive, and hence we would want to avoid. So at the current juncture, financials are still looking good. I remember last time also when we spoke about it, I mentioned about that. Financials continue to do well. Both the credit cycle as well as the growth cycle is favorable for them. And now with a view that rates are soon going to start coming down, even NBFCs will start to look interesting. So there is already a trade which is happening where people have now started to look at NBFCs versus banks. So both the private banking space as well as the NBFC space is now looking good. Wherever there is a cost inflation pressure during COVID or post-COVID, those sectors are now coming back. Say, for example, cement. Now coal prices are off, freight prices are off, so cement is starting to look good. Demand is expected to pick up. Or something like pharma. You need to be very selective in pharma, but whichever companies which impacted because of higher API prices or higher raw materials coming in from China, now the China supplies have resumed. So these companies are getting those margins back, and hence one can look at this sector also. So within most of the sectors, one has to be selective. Whichever companies lost out or got impacted due to COVID, they are getting the margins back, they are getting the earnings back, and this is the broad theme that we are looking at, the companies that are benefiting out of the lower raw material.
Aman, the last time we were talking, you were talking about as to how you don't have any exposure to globally linked spaces, and you specifically talked about as to how you don't have major exposure to the Indian auto sector as well. Are you still maintaining status quo on these two statements?
On autos, yes, we still don't have exposure. The call has not worked that well. Markets have done well. Auto companies have also done well. But we continue to maintain our stance that it's not something that is thematic for us. It's more of a tactical trade, and we would like to skip the tactical trade for now. And auto companies in India are neither fully prepared for the EV, and the valuations are completely out of sync as far as the global valuations are concerned, where all the global majors are still trading at a single digit P, except for maybe Tesla. So autos, yes, still we don't have exposure. Globally linked sectors, we indirectly say we would have a single digit exposure to commodities, or we would have a single digit exposure to IT, which are in a way linked to global sectors. We don't have a direct exposure like a company would, where exports would be the major driver, except for say IT.
Morning. You said you'd completely avoided the IPO space, but wondering what would change your mind. Are you not convinced by the company's commitments to maintain profitability, turn things around within the new age fintech space?
No, the companies which came up for IPO, the great companies, great management, great business model. The price at which they came in was not something which was comforting to us. We felt there was a froth as far as the valuations were concerned, especially for the new age and the e-commerce platform companies, and that's the reason we completely avoided them. So tomorrow, if there's a new IPO with a similar business model but at a valuation which is better, where you are being judged based on the EBITDA or profit and not your sales, that is something that would be comforting to us. And if that happens, we are more than happy to look at the space. So it was predominantly valuations which we are not comfortable, for which we avoided most of the new age companies.
Aman, as we roll from the first half of this year to the second half of this year, one tailwind is lower commodity prices, something which we've also spoken about. But what about the other tailwind, which is lower interest rates? What's the best way to participate in that?
Lower interest is the best way is NBFCs, because even if you look at a corporate side, lower interest rate would mean maybe 100 bips of improvement into the margins kind of thing. So that's not a big delta. But for NBFC or for the financials, lower 100 bips or 50 bips of lower cost of income or lower interest rate would mean at least 15, 20, 25% growth in their profitability. So if one has to look at the prime beneficiary of a low interest rate, it has to be financial sector and predominantly NBFCs.
Let's say switch out of large banks and move to large NBFCs or mid-cap NBFCs. Look, banks do very well when you have an interest rate uptick, especially in the first leg of the uptick. So banks have done very well. NIMs have expanded, credit growth has expanded. Now it's the other way around. So time to get out of corporate banks and go to NBFCs?
Yeah, that can be a one way to look at it. It all depends as to how much exposure we want to have into NBFCs. Say NBFCs, banks any day are more, we can say, a long-term sustainable business model versus an NBFC, because they have a good liability franchise, right? So from that perspective, for the next say 2 years, NBFCs can do better than banks, but it's not that you just completely switch out of banks and get only into NBFCs.
I distinctly remember exactly a year ago you were at our office and we started talking about small themes, and you were very bullish on railways, and that theme has done very well. And I distinctly remember that you were bullish on, let's say, and these are your portfolio companies, so we can talk about it, names like Titagar. Where are some of those railway stocks headed?
Railways to us is a multi-year theme. It is not just they have these companies will do well on a 1 year basis. The way the Indian railways are getting modernized, the way things are changing, and the way the government focuses on this segment, we feel next 3-4 years at least, the order book, the business outlook for most of these railway companies is going to be positive. It's also that they are coming out of a long run. Most of the companies in the railway sector, they had a rough or a bad patch for almost 7-8 years, right? So you're now coming out of this. It is not just going to be 1 year of good year. You're coming out of 8 bad years. At least next 3-4 years are going to be good years for most of these companies. So from a business standpoint of view, most of the companies now have a 3-year order book visibility, the way a typical typical EPC or a construction company would have. Same thing is now happening with these railway stocks also. So they have 2-3 years of order book, and over the next 2 to 3 years they are going to add on to this order book. For the next, I can safely say for the next 3 years, railways business wise is looking good.
Aman, the last time we were chatting, you were talking about as to how you're constructive on the pharma space. Since then, of course, many of these pharma names sporadically have given good returns as well. Wanted to understand whether you've been adding up, exposure along the way and adding to your positions.
Yeah, we are adding to the pharma exposure, and as I mentioned, we are looking at companies which are benefiting from the lower raw material coming in. So that is one space that we are pretty positive, and the domestic pharma space that is doing steadily well. So these are the two sub-segments within the pharma space that we are currently focused on.
Also, is there more legs to the entire infra and construction space? I recall you had earlier talked about as to how the risk reward is in favor of the sector. We've seen some decent moves play out, but how much more of a headroom do you foresee here?
Yeah, past 3-4 months, this sector has done well. Most of the stocks would be closer to the 52-week highs, and I think over the next at least 2-3 quarters, this segment will continue to do well, because before the election comes in, the 6 to 9 month space is when we see high tendering activity, we see high incremental orders coming in, and this is something which is going to be a positive news for the full sector, and that is obviously going to benefit the stocks. And after the recent run up also, they are all trading in say mid-teens kind of valuations. It's not that valuations have completely gone out of sync and they can become too expensive. So 15 PE for a 15-16% ROE business which is growing at 20% plus is still a very decent valuation in current markets, and I think there's still room for these stocks to continue to do well.
All right, appreciate your time. Thanks very much for giving us a sense as to what you're looking at when it comes to individual sectors as well as your market outlook as a whole.